Hey guys, welcome back to the channel. I hope everyone is doing well. So first, I want to thank some of the supporters out there that have either just giving a like or subscribe or even like a super thanks. Those are greatly appreciated. This helps like the channel. Well, I guess like first stay alive, and then hopefully after that, then maybe we can start growing again. So it might be a good idea to start thinking about things that are outside of like the option-based high yield space. So let's get into it. So over here, so again, this was like a viewer supported topic. So I want to thank this person over here. So I appreciate the time and work put into the channel. Would encourage you to look at other high yield contents. This is a big part of the channel. Uh, that's a very good idea, like BDCs, CES, or other income producing strategies like SFOL, for example. I think that you will help bring in newer folks and also diversify a bit more and still staying with the theme, as you point out. Some of these newer funds may be short-lived, so strategically, I think it would be wise to go beyond these types of funds in your content with that in mind. Of course, only if it interests you, and of course, it definitely does interest me. So that's why I just want to thank this person by kind of like just creating an entire video just for this topic, and maybe more to come in the future. So hope you don't mind the suggestion. Oh, I definitely don't mind. This is actually very great. Appreciate all your content and always being informed on what's coming out in the crazy high yield world. And yes, definitely things are getting kind of crazy in the high yield world. Although I wasn't expecting it to come this soon. I don't know if people are just maybe starting to get bored or disillusioned or whatnot. So I guess the good news is that not all high yield option ETFs are in the toilet. I mean, some of them you have to keep in mind that since it's volatility based, well, obviously if volatility is low, then these ETFs will kind of correspondingly not do so well. Not everything is in the toilet though, so there's still some time I think for people in general to kind of enjoy the yields. But I think it is a definitely a good idea to start exploring other ideas so that in the future, uh, I don't know exactly when, but it's good to have like kind of like an exit strategy. So like the ideas that are suggested, like business development companies, the closed-end funds, and well, maybe SFOL. It's I would kind of lump this in with the high yield option ETFs at some point. Like for example, if volatility skyrockets, like this fund is going to be in trouble. But let's kind of get into it some more. So obviously, none of this is financial advice. There's no way for me to kind of know what's in everybody's portfolio or how much you have. Uh, I'm just gonna like do this kind of like as a general thing. Some of the ideas presented here are based on some of my past trades, but remember, this is based on the past, and of course, nothing is guaranteed to work uh, going into the future. So I have some positive experience with business development companies, specifically a company called Maine. Uh, Back then, like the the yield was a lot higher. Uh, well, back like around I want to say like around 2020. I mean, everything was on sale, so this at the time was a good pickup because I thought, oh, this is nice because it also happens to have like a monthly payable. But if obviously, like right now, since there's so much competition for yield now, that the price is kind of bid up. It's trading at 52-week high. It also has options, but sometimes the liquidity isn't like that great. So I would definitely recommend if you decide to explore this some more, definitely work those limit orders. So for me, like personally, right now, I'm keeping it on a watch list. I have no position in this. And I think like what business development companies, what the value proposition is in maybe in like in a weak market or like a weak economy, these business development companies could offer a lifeline to like small and medium sized companies. But of course, like there's like a price to pay for this, like the interest rates for like the ones that are taking the loans. Obviously they kind of have to factor in like you know do they have enough cash flow to kind of like pay out like the interest to the main company. So this is something you have to kind of keep in mind. right now, allegedly, we're in a decent economy, and so maybe like this business development right now, like the returns like right now probably won't be like that enticing. But of course, like as things like head south, it might be something to explore. Like definitely if we can, like for myself personally, if I see it at like a 52-week lows or maybe like just like some extreme event causing like the market to sell off, then that's like when I'm starting to get interested. Another area to kind of maybe explore in the future are closed-end funds. So basically, generally have a fixed share count. So the premium and discount to the net asset value can get pretty nuts. Like they can get pretty extreme. So both in terms of people overpaying or people like they're not even paying attention and they have like these crazy discounts. But also like none of these are like perfect. None of these like topics are you know are good. Like this is why people should practice like good portfolio allocation because like if one area suffers, another one should take its place and overperform. And one thing to note about the closed-end funds, they could definitely get liquid, especially during bear markets, because when people start just selling stuff indiscriminately, uh, there's going to be like a lot of deep discounts, but there's a reason for that. You have to look at the holdings and watch out for a lot of like financial task waste because some of these like have a lot of either a lot of leverage or they have like some funky derivatives involved. So always like just do your homework. And I've brought this resource up before, and I'll link it again in the description below. This is something that you might want to consider, like just looking up on your own time or playing around. This is called CEF Resource Connect, and they're sponsored by Nuveen. So this could be like good or bad. So I don't know if there's any censoring. So for example, if like you know I don't know if they'll want to try to like portray like the Nuveen funds in a positive light, and then like consequently the competitors in a negative light. But so far, I haven't noticed anything fishy for those for this screener. And then, of course, it's free, so that's always a good thing. And just to kind of like maybe as like some suggestions. You can always like run the screener and just play around with the different settings. For example, for this one, I just did something quick on like in terms of like distribution frequency. So ideally, I would like to see something that pays out monthly. And then I also did like a really basic discount like screener as well. So like these funds, um, you can kind of like see like just by ranking them by in terms of distribution rate. But again, be very careful because like for example, we'll look at NXG. So at first glance, you might say, "Oh wow, the distribution rate is over 16%. It pays monthly and it's trading at a 10% discount." And then you might think, "Oh wow, this is such a great bargain, and let me let me grab this." But hold on, you always have to do your homework and see like what's inside. And usually when something trades at a discount, there's the usual reason for it. So let's just take a quick look at like some of the basic things that you should look out for. So the effective leverage on this guy is almost 25%. So I mean it's not the worst that I've seen, but it's a little bit on the higher side. So of course like be careful with that. And then look at like the expense ratios, like 4%. So it's there's something like you might want to consider as maybe like a shorter term trade, because like if you hold this for like years and years, like you're just gonna grind down your initial capital that you invested. And remember, just because something trades at a discount, it might stay at a discount for a long time, especially when things are illiquid. And then also for SFOL, so I've also mentioned this in the past. It's not a bad fund. Simplify. They have like some interesting like concepts, but of course like there's the usual reminders of just because on paper it looks like a good fund, you still have to watch out for high yield tourists because if too many people pile into the position, it dilutes your yield. So just be careful of that. And then there's also an issue of concentration risk. So I know a lot of people are really into like the high yield option ETFs, but you have to be cognizant of the fact that, well, most of these funds are either covered calls or cash secured puts. So of course, like that means like these are short volatility strategies. So if you pile on S-fall on top of that, I don't really see the point, because like if you have like 80 to 90%, like just as an example of short volatility, you're gonna get wrecked. Well, actually, I should say your portfolio will probably get wrecked when volatility returns. So it's kind of like the old joke, like you're going out to the store and like you want something, but then like mom says, but you already have short volatility at home. So one thing to be aware of, S-File is obviously short volatility. So if you already have, let's say for example, triple QY or MSTY or whatever, uh, since those are already short volatility, you're piling another short volatility ETF on top of that. For me, that doesn't make sense, because like when volatility spikes back up, the portfolio could get hurt. So this is as followed by like, again, it's not a bad thing, but I think it might be better if you pair this up with like more normal uh, normie ETFs, like for example, like SPY or like SCHD or something like that. Uh, Basically anything that doesn't have short volatility or covered call exposure. This could act as like kind of like a surrogate on top of that. And then, in general, be careful when stretching for yield, because I think at some point I will also want to maybe start slowly incorporating more crypto content in here back again. Um, I think I may have gotten a little too late, but I think there's still like plenty of room for crypto to kind of to soar later for the year, and then also maybe up until like 2025. But I just want to warn people about getting burned in the past for by crummy crypto companies. For example, I was involved in something called Terra Luna because at the time they offered like 20% yield on their stablecoin, which unfortunately wasn't so stable and it lost like pretty much all its value. So it was basically I'm left with dust. At the time, I was actually very lucky. I escaped with like over like half like the initial capital that I put in. So the only good thing that I did was like obviously I didn't put everything in there, but I put I think in hindsight a little bit more than I should have. And then the next thing Gemini earned the at the time they had 7% USD like stablecoin yield. At the time, like when you compare against like other crazy like crypto yields, like, it seemed like a pretty reasonable and safer alternative. But unfortunately, like they loaned it out to Genesis Trading, which in turn like Genesis Trading lent it out to like firms like FTX, I believe also like Three Arrows Capital, and a whole bunch of other like scumbaggy type of crypto companies. And unfortunately, when you combine like excessive leverage and then also just like no risk management at all, um, then that unfortunately led to like the whole crypto space almost collapsing to like ridiculous levels. So just watch out for like in the future about like future DRO's Capital, BlockFi, Celsius, um, digital currency group slash Genesis Trading, FTX type of companies. Like if the yields like look too good to be true, just be careful. And at the time, these companies like they look like they were safe on the outside, but you really have to do your homework and just like read through all of the documents, um, just so you can protect yourself. Now, the good thing is not all crypto is bad. I guess like for myself, I'm gonna probably stick towards like the maybe like the top maybe top three major I guess like cryptos like as of right now, in my opinion, it'll probably be just like Bitcoin, Ethereum, and maybe Solana. Just for myself, and I think like the Bitcoin spot ETFs have shown there's like a lot of pent up demand. I'm debating whether I should share some the strategies that have been working out well for me. But again, I guess like I want to avoid like the issues that I had with like high yield option ETFs because if I share too much, people will try to copy and then I wind up hurting myself and potentially subscribers that are also trying to do the same thing. So I guess I have to see like how much information that I want to give out. So but then I'm also like the one of the good things about the spot Bitcoin spot ETFs. I'm still waiting impatiently for options on the actual like Bitcoin spot ETFs. So I know there's like some like what is it like YBTC and like BITO and those guys, but those are based off of like futures, and I'm not interested in those. But that's just me. But you guys can do whatever the heck you want. It's your money. But I think the I think like the next meeting with the SEC or for like in terms of like getting like the Bitcoin options on the spot ETFs, I think it's April 24th if I remember correctly, or somewhere around then. So I'm looking forward to if they can approve this or not. Uh, so like for example like IBIT and FBTC. Um, I've made like videos on this before, but maybe I guess like, when the time is right, I'll maybe do some more. And of course, like there's you know risk to like almost anything that you put in your portfolio. I would just like say keep an eye on your holdings routinely, at least like once a month. And then also don't forget to take out the trash on a routine basis. So I mentioned like recently I stopped out of like triple QY and Tesla. So unfortunately, they're not trash, but like they're trash in terms of like context of like the I guess like how should I say it? Like they underperform um for me personally. Just because like I didn't keep my cost basis low enough as compared to like the NAV, and also just like underperforming like the market in general. So I'm just gonna be more careful in the future, and I suggest you guys like routinely like check up on your high yield option ETFs if you still have them, and just keep an eye out on potential future opportunities, because at some point I guess like when volatility spikes back up, there might be like a rush to the exits, so you might want to start thinking of, like now about like what could potentially happen, and just like make plans if you haven't already done so. So once again, thank you for liking, thank you for subscribing, and of course, like super thanks are greatly appreciated. I'll try to keep, um, I guess, like if there's like any reasonable requests and topics, those will definitely get priority, kind of like this video. So if you have like suggestions or like maybe questions, I'll try to get to them as best as I can. So obviously, if you put in the super thanks, those will definitely get priority. And then like the other questions, I'll try to get to them as as time frees up. So again, thank you for your support, and I'll see you in the next video. Be safe out there. Bye now.